Hey, good afternoon, everybody. Thank you for joining us today on our webinar here. And we're going to be focusing in on portfolio power, maximizing returns with informed decisions. And we're going to be here for about an hour. And I want to make sure that we go through a couple of housekeeping items here. And one of them would being which, if I can learn how to turn the page here. Oh, I got a delay, that's why. Myself, I'm Craig Cecilia, Chief Investment Officer here at McQueen Financial. And I have along with me our special guest, Miss Alicia Bradley. She's a senior investment advisor here at McQueen Financial. She works with our clients, advising them on their investment portfolios, as well as giving advice on managing interest rate risk with their ALM reports and her CECL reports, and then does some training as well with management and board. So thank you for joining us today, Alicia.
Thank you for having me, Greg.
Absolutely. Um, Administration here is we have on your screen a chat button or a question button. Feel free to click that and ask throughout the record throughout the meeting today. We'll be monitoring them and asking or answering some of them as we reach some topics that are important and address your questions, and then some we'll have at the end as well. We are recording today's message as well, so you can hear and see Alicia's great wisdom that she'll be sharing today throughout the whole year. It's on our website with all of our other webinars that we record and uploaded to our YouTube channel. So, Alicia, what am I forgetting? Anything on the
No, I think that's all of it.
Fabulous.
Yeah,
All right, well, I'm going to give a little overview today, and what's really important is we want to share some ideas with you so you can maximize the returns in your portfolio today. Some of the key topics we're going to be covering is things we covered in the past, but we're going to go a little bit deeper with duration, convexity, and optionality. And what I really like is we're going to be looking into a few asset classes and comparing the value in a couple different bonds, say in
yeah,
some maybe the CMOs or in munis. Uh, it's going to be fabulous with respect to finding that value because that's what we're really at the end of the day, mitigating risk and not eliminating it.
absolutely. Yep, got to be able to manage it.
Yeah, and maximize returns. So let's get started a little bit and start talking a little bit about duration here, Alicia.
All right. Duration is something we don't talk a whole lot about when we talk about bonds. We talk a lot about weighted average life, but duration is one of those important pieces. From a pure definition standpoint, duration is a measure of the sensitivity of the price of a bond to a change in interest rates. Or more simply put, in layman's terms, how the market value of a bond changes as interest rates change. I have a note on there, duration is not average life, because while they may be very similar, they are not. If you want to flip the slide there. There's a few things that impact duration. Our time to maturity or our maturity date, what the coupon rate of that bond is, what the yield of that bond is, which is then obviously dependent upon the coupon rate in the market in which we're buying it. And then what sort of call features does that bond have or not have? And why is it important? Duration impacts the portfolio's weighted average life. So stated there, consequently, the longer the weighted average life, the higher the price sensitivity. And that higher price sensitivity impacts our Neve position. So it's something that we want to be cognizant of when we're putting together either a new investment portfolio or adding a significant amount of cash, or even starting to diversify amongst asset classes, is noting what the duration of the current portfolio is, and then how will it change as we make those shifts within the portfolio so that we're aware of that change in price sensitivity.
Yeah, really good points there, Alicia. And I think we're going to talk a little bit later of, not only the duration of their investment portfolio, but you say it's the overall need of an institution. And so what is the duration of our liabilities that are out there as well? And
Absolutely.
how do, and our other assets and how do they all complement each other? So really good stuff there.
Yeah.
A really high level example we have here on the page. We've seen this in prior webinars, but it's super important just to really understand this. And what we're showing here is that it looks linear in when looking at this picture, meaning a duration of 1 and interest rates go down 1%, we're going to be losing a value of about 1%. And as you go down in this table, the 5 duration devalues 5% with a 1% rise in rates, and so forth with that 10-year. And it does appear to be linear there, but there are other factors, as you pointed out, Alicia, on the prior
Yeah.
page, right?
Yep. There are a lot of other things.
Yeah.
One of them is convexity, which we're going
Well,
to
coupon is what I was kind of
coupon.
thinking.
Well, coupon is a big one.
It's one of the C words,
It is,
right?
it is one of the C words. So is Craig.
Yeah, right,
Um,
Craig. Yeah,
but
Charlie.
yes, the coupon of the bond is one of the biggest drivers of that duration. And a great example would be, because we don't have it listed here on this page, is if we're buying a 1% bond today and today's market rates are 5%, it's going to have a much different change in duration as if you were buying a 4% bond and current market rates today are 5%.
Yeah. And we saw when we were in that really low rate environment for such a long time, and
Terrible.
everybody was buying 50 basis point coupons, 1% coupons,
Yep,
2% coupons versus today. Those are going to have different duration, even if it
different
has a
duration.
similar maturity. Yeah, exactly. So, and it's interesting because you look at that unrealized losses, and there's some that have to do with that, right?
Yep,
There's a lot of
absolutely.
factors. So
Yep.
now on to one of our favorite
Convexity.
words. Yes, convexity.
Convexity, you have heard Charlie talk a lot about it, and simply stated, don't add negative convexity to your portfolio. So we're going to talk about a bit convexity, what it is, what negative convexity is, and how it impacts overall portfolio decisions and then the overall portfolio. So definition standpoint, uh, convexity is the measurement of sensitivity of a bond's duration to changes in yield. Craig walked through the example on the prior page. Duration is often assumed to be a linear change. However, it is not. Convexity is what shows us that duration is a sloped or quote unquote convex, that it is not necessarily a linear change.
Absolutely. And different characteristics of very similar bonds will give different convexities and as
Absolutely.
well. It's super important to understand those, and we'll talk about those optionality things as well.
Yep. So we've got two different types of convexity. We have positive convexity, which is a positive for the investor, and negative convexity, which is negative for the investor. There are some examples of types of bonds down there at the bottom. So your positively convex bonds, your most basic one is your non-callable bond. Why is it positively convex? It has no optionality to it. Here's your coupon, here's your stated maturity. Done and simple. Bonds with a make-whole call are considered positively convex because the selling issuer has the ability to make the buyer whole. Sometimes it results in a increase in dollars that the buyer receives if that make-whole call is issued. Sometimes it does not. I know those of you who are on the call who are investment clients hear us say, we don't buy make-whole call bonds. We do, but we want to buy them at a discount so that if that make-whole call gets enacted, we receive more back than what we've paid or par at an absolute minimum. We don't have to worry about any sort of losses. Those negatively convex bonds, the example there, most MBS bonds, anything callable in preferreds, which are then callable. And the reason that they're considered negatively convex is because if we buy a bond today, and I'm making these yields up because they don't exist in the fixed income market. We buy a callable bond at 7%. Rates fall tomorrow 100 basis points, and the new current callable issuance rate is 5%. Well, that 7% bond is going to get called, and we now have lost interest income, and we have to reinvest it at 5%. And that goes back into that why is a bond negatively convex? Because it works against the investor. So that duration increases as yields increase, and it decreases significantly as yields decrease.
Yeah. Thank you, by the way, for explaining because it does, and we've had this question before of, wait a minute, you're saying a whole make whole call, i.e. call is good, but a callable bond is bad. And to make
Bad.
that the key is those two words of make whole,
Make
right?
whole. Yep,
That
absolutely.
calculated. Yeah. So thank you. That's awesome. Good stuff. And as I look at, is my screen not turning again? Is it delayed? There we go.
There we go.
As I look at duration and investments and overall impact on the portfolio, it's really important to think about what your rest of your balance sheet is doing. Because
Yep,
as you just mentioned, you can have a duration that goes out when you have
correct.
optionality. And when that happens and you're doing a value and change in value and for a variety of simulations, it can really cause you to fall outside of limits in different rate environments if you're modeling that bond correctly.
Absolutely.
Yeah,
So super important to know how those all impact together to make sure that your loan portfolio and your investment portfolio are balanced on your balance sheet.
yep, right on. Okay.
And then we have optionality. Also a piece of duration and then convexity as well. So optionality is an option that allows, or special options that are issued to either the issuer or the bondholder. More often than not, they are given to the issuer. And the most common types of things are call features. We talked about make whole calls a little bit. Extraordinary redemption provisions or ERPs, and sinking funds. All of these things. Craig's got a question. Go ahead.
Oh well, I'm gonna be the messenger.
Okay.
Somebody's asked extraordinary redemption provision. How is that different than a regular call, and is it easily identified?
Let's start with, is it easily identified? Yes, it will say on your description screen that the bond is subject to an ERP, and that's all it will tell you. You can click in further on that description screen to find out what that ERP is. And 9 times out of 10, it says, see the prospectus. An extraordinary redemption feature gives the issuer the option to call away a bond at any time, generally for any reason, before the standard call date. So your standard call feature is going to say, if we have a bond with a 2035 maturity, this bond is not callable until 2030. The ERP is going to say this bond is callable at any time for any reason. They often give a list of reasons in which that bond would be callable. We most often see them on housing municipal bonds. But the call feature can be enacted at any time, regardless of date.
What you said that scares most investors on these when they have them is that callable anytime. Because
Anytime.
because a lot of bonds just get shown with, hey, here's the call date in 4 years or something of that nature.
Correct.
And then they don't factor in a little bit of risk here. They don't factor that into the price they're paying and their actual yield to extraordinary redemption as opposed to yield to call. So very important,
Correct.
scary, right?
And it's something that has to be paid attention to. When we are looking at bonds that have ERPs on them, regardless of the issuance or issuer, we want to make sure that they are at a discount or par, because those extraordinary redemption features are often enacted at par. So if we buy a bond today that has an ERP and we buy it at a premium and it gets called away next week, well, all of that premium is at risk of being lost. And that's not the kind of loss we want to take in any sort of portfolio. So making sure you know the purchase price of your bond when this optionality exists is incredibly important.
Yeah. Let me make a quick note here.
Yeah.
Losses are bad. Okay, got it. Thank you. All right, so moving on here, I got a question for you on
Yeah.
this here is um why? Why is it so, what is the purpose and why do they get issued at instead of why is it important, but why is what is the purpose of this optionality in the portfolios from an issuer, from the investor standpoint?
So from an issuer standpoint, it gives the issuer the ability to call the bonds away and reissue them at a lower rate. So it's just like refinancing an auto loan or refinancing your mortgage. The issuer wants the lowest cost possible. So does your average consumer. So it gives the issuer the ability to go back to the market and say, hey, we're pulling these bonds at 5%. We're going to reissue them at 3. The issuer then saves on that cost. From the investor standpoint, there's often a premium involved. And when I say premium, I don't mean in terms of dollars, but in terms of yield. So the issuer is compensated with a higher yield to take on a bond that has optionality, knowing that that bond may not make it to its final stated maturity.
So it's like a teaser, like a little teaser rate on this
Yes,
investment.
absolutely.
Okay. Uh, we covered a little bit of why it's important to pay attention to, right? Because
Yeah.
of that
Yep.
uncertainty in the rest of the portfolio, and is there a place for it within the portfolio? Um,
Yep.
and can it be a place in the portfolio for something with optionality is the real question.
I think there's a lot of different ways to answer that. It isn't always simply a yes or no question. It's important to pay attention to what is that final stated maturity, and are we comfortable holding that bond to final stated maturity? We can't analyze for an ERP because an ERP could happen at any day. But if we have a standard call feature, what is that standard call feature date and how does it fit into the portfolio? And if the bond gets called, are we comfortable with that call date? Um, the one thing we don't talk about a lot in optionality is, does the buyer have any sort of options? There's not a significant amount about that. We talk about puttable advances when we're talking about FHLB, where then the buyer or the me as the taker of that advance has the option to put it back to FHLB. But that's pretty limited on what sort of buyer optionality there is. A lot of it stands on the issuer side.
Yeah, I think there's also some convertible bonds as well. But
Yeah,
for our audience today, most of those are not going to be appropriate because you're converting to like equities more often than not. So
correct.
really
Yeah,
wouldn't kind of work there. So it's for a different type of portfolio, like an insurance company would be a great example for
yeah,
convertible debt.
yep,
So good question. All right, well, we're going to move on a little bit here and see an example of the purpose. Be honest
yeah.
with you here.
So we have here two different federal farm credit callable bonds. You can see the coupons on them are very different. The top one being at 4.27%, the bottom one at 4.52%. Very similar maturities. They are 1 day apart, both issued at par. The difference on the two bonds is the lockout period. The bond at the top has a 1 year lockout, meaning that it isn't callable until August 20th of 2026. The bond on the bottom has a 3 month lockout, and so it cannot be called until November 19th of later this year. The big thing to notice, though, is the difference. It's a 25 basis point difference to take that shorter lockout period. So this goes back to where may it potentially fit in a portfolio. We aren't recommending either one of these bonds per se. It's just an example to show the difference in yield between two options that are very similar, but have a different optionality structure to them. So in this instance, an investor would be getting paid 25 basis points more to take 9 months less of lockout if that were the bond that they opted to choose. Now, both are continuously callable. That didn't change. It's just that difference between when that first call date is in today's market is equivalent to 25 basis points.
And I noticed on here, they're like you mentioned, they're both continuously callable
Correct.
bonds, right? What are some other periodic call features that could exist besides continuously callable?
If you want to make it up, it exists. Um, the most common ones we see are quarterly, or we see bonds that have a 1 year lockout and a one-time call, meaning that it is only callable at that 1 year date, and then it turns into a bullet structure from there on out. Sometimes we see a 2 years, but the most common features are continuously callable and or quarterly callable.
Yeah, I love that you gave a couple of examples of how it could be structured, and it just depends on how you really want it to be.
It
And
does.
the reason I wanted to ask that question too is going back to your advice of understanding the optionality, right?
Do
You
you
could,
know what you're buying?
do you know? And when you're modeling, are you able to model the optionality properly, a continuous versus a one-time versus a quarterly? And
Yep,
we've seen in a lot of our ALM validations where they're not necessarily being modeled properly because of the optionality or being so complex. I mean, the buyer knew what it
yep,
was, but
correct.
the model's not handling it.
The risk isn't being shown in their ALM modeling.
Right.
Yep,
So super important there. So thank you for sharing that.
absolutely.
Absolutely. Okay. All right, so one of these things that we've been talking about and why we're here today is to maximize portfolio yields. And what the example that you just gave, Alicia, on the different callable structures and the different yields is it just yield we're looking at? Is it just value that we're looking at when I think about these things? And basically, when you're thinking about yield, you're thinking about what are your earnings? Now, what am I going to earn on this bond for the as long as I own it? I can't say all the way to maturity because we talked
We
optionality.
don't know.
Value is what we really like to talk about, and it has to do with what is the earnings on this investment over the riskless curve,
Yep.
also known as the treasury curve, and
Yep.
hopefully it'll stay that way for
Knock on
forever.
wood.
Yeah, knocking on wood. We are the gold standard still. Uh, but what we also want to think about is what is that spread? Because you just can't compare. I'm earning a spread of 30 basis points versus 50 and say 50 has the value, because then you have to bring
Absolutely.
in credit,
Credit.
right? Is there other optionality in there? And what happens if it's fixed versus variable as well? But
Yeah.
ultimately, value is what you're investing in, and
Yeah.
making sure that you're maximizing that portfolio.
Yep. And the value for everybody is different. Um,
Mhm.
and I stole this slide directly from Zach Montroy and Craig's last webinar. So sorry, not sorry. Price is what you pay, value is what you get. Famous Warren Buffett quote. One thing we want to pay attention to is we don't want to focus on the short-term swings in the interest rate curve, or in yield or in price movement, because those are all things that change on a day-to-day basis. We want to focus on the value of the bond or the investment that we're purchasing for the investment portfolio and following our strategy, because those changes are going to happen whether we buy a bond today, tomorrow, or in a week and a half. So we just need to pay attention to that and be cognizant that those changes are going to happen, in the marketplace.
No, very well. Well said, Alicia Buffett.
I tried to explain value as a concept to my daughter because I was thinking about this presentation this weekend. We went to a concert this weekend and a bottle of water was, I think it was $9.
Ooh.
And she almost said to me, "Don't buy it." And I'm like, "It's 89 degrees outside. We're going to buy a bottle of water." Um, so we were talking about the concept of value on the way home. And I said, "Well, that bottle of water was $9, but did we really want it?" And she's like, "Yeah, because we were so hot, Mom." And I'm like, "And how much was the bottle of water at the gas station?" She's like, "It was $2." I'm like, "But did we need to buy the bottle of water at the gas station?" She's like, "No, we bought it so that we didn't need to buy water at the concert. Couldn't bring water into the concert venue." But that value is different depending upon the instance that you're specifically looking at it in. So for one client, they're going to see value in a bond, and the next client may not. Just like she didn't see the value in the $9 bottle of water, and I did.
That's just a fabulous example. As we look through the thousands of offerings every day, we're going to keep that in mind in
Yep.
evaluating the value. I love it. I love it. So the other thing that we haven't talked about with optionality and is what is the coupon with respect to being fixed or variable? We talked about how the duration gets impacted by various coupons in this coupon stack.
Yeah.
But there are a lot of bonds out there that either are fixed rate or variable rate. A fixed rate is exactly what it is. It's a fixed rate that you buy, and you're always going to be getting that coupon payment until you no longer have the investment either being called away, matured, amortized down.
Yeah.
Right. And a variable rate could be a variable rate that is reset to us as investors, either on a daily basis, monthly basis, quarterly, annual. There's a lot of different reset frequencies, but ultimately, the bottom line is it's changing its rate. And it's
Correct.
typically pegged off of some sort of index. It could be off of SOFR, it could be off a
Yep.
treasury market the 1 year, some prime-based things, depend if we get into SBA, some prime-based coupons.
Yeah.
But ultimately, it's really important to understand that optionality and what the tendency of interest rates are going to be, because today's variable rate coupon might not be the same coupon that we'll be earning over the life of the bond.
Absolutely.
So yeah, so the us as investors, we all have that crystal ball that's exactly right.
Yes,
We'll know where interest rates are. We know exactly what we earn on a variable rate
absolutely.
coupon, right?
Yep.
So, in being facetious, obviously, but we do have to look at why would we want to look at a variable rate investment,
Yeah.
right? Some of the things that we would look at are the rest of our balance sheet. And I think the next page will give a few examples of that
Yeah.
is what we're looking at here.
We sure do. So they're all posed as questions, questions to ask yourself when you're deciding, do we want to look at fixed rate bonds or do we need to look at variable bonds? So thinking about to answer the question, what fits my portfolio best is what does the other side of your asset balance sheet look like? What is your lending portfolio? Is it made up very heavily of all 30-year fixed rate mortgages? If so, let's look at some variable rate paper so we can take advantage of that rate movement and not necessarily have so much extension. But if your loan portfolio is a lot of variable rate paper, we know that in a down rate scenario, obviously those loans are going to reprice. We're going to earn a little bit less net interest income. We can put more fixed rate paper in the portfolio to help lock in that net interest income and earnings, which answers the next question as well. What kind of loans do I have on my balance sheet? But what does my net interest income position look like? Right now, we're seeing a lot of clients who have a decrease in their net interest income in those downwards rate scenarios. So making sure that that excess cash is put to work to lock in those earnings today to help preserve future net interest income. But then also from a Neve perspective, which is the other risk piece to ALM, if you have a very high negative Neve ratio in an upwards rate scenario, variable rate paper will help to reduce some of that sensitivity on the balance sheet. It's going to reprice as the market reprices, and helps account for that market movement that the fixed rate paper doesn't get because it is a fixed coupon and it will not change over the course of its weighted average life. So there's a lot of different bits and pieces that go into looking at what fits best, whether we're looking at fixed rate paper or variable rate paper.
Yeah. Well said. Very well said. I sometimes digress into elasticity of deposits and are they,
Yep.
if we don't move rates, if rates move, and because we all pretty much in the country or on the globe have more non-maturity deposits than we do than fixed term deposits and stuff,
Yep.
but it all really
Absolutely.
factors in there. So nicely said there, Alicia.
Thank you.
You're welcome. Okay, I wanted to talk about this briefly and hand it over to Alicia because she is by far our expert in mortgage-backed securities and CMOs. And defining the differences is one of the things that we want to kind of do is the difference between
Yeah,
these. And mortgage-backed securities and CMOs at one point in time, and I think they still are, is one of the largest sectors that exist in the bond market.
they are. They
And
absolutely are.
yeah, and depending on if somebody has a big portfolio of mortgages, they may or may not have them on their balance sheet. But the majority of financial institutions do have either one or the other or a good mix of
Yeah,
pass-throughs and CMOs, right?
absolutely. Um, so the next section kind of focuses on finding the value between various asset classes. And right here, we're going to kind of pit MBS versus CMOs. Some clients are super comfortable with both. Some clients are only comfortable with mortgage-backed securities, pass-through structures, and don't want anything to do with CMOs. I had a client actually yesterday on a call tell me that a long time ago, when he was learning about different bonds, CMO stood for count me out. It was the first time I had ever heard that. I thought it was kind of cute. Um, but do you understand the differences when you're looking between the two types of paper? While a CMO is incredibly similar to an MBS in that it provides amortizing cash flow, it has a much longer dated final stated maturity, it has a weighted average life, it's backed by most often residential mortgages. It's a very different structure than an MBS. So making sure that you understand the difference between a mortgage-backed security pass-through and a CMO or collateralized mortgage obligation is different because at the end of the day, we want to make sure that everything that we are providing investment advice on are things that you are comfortable with. And then the other piece is, where does your comfort level lie? Some institutions simply don't want the additional risk that comes with a CMO. And when I say additional risk, a CMO is built by, there's a shelf created. So you have your name of your bond, and then you have all of these different tranches underneath. And each tranche has different characteristics. And the cash flow of those tranches are different. So making sure that you understand the differences in the cash flow of the tranche that you're purchasing versus just a standard pass through, where, Craig, if you make more, if you pay larger payment on your mortgage payment this month, it automatically flows through into the pass through. The investor gets a pickup in their principal payment. On a CMO, Craig could make three payments in 1 month and you may not see any of it. It all depends on how that cash flow is structured. So making sure that you understand that difference and are comfortable with those differences.
I like that last example with respect to additional payments on the underlying collateral and how it flows through, Alicia,
Yeah,
because there is a negative connotation to CMOs,
there is.
and you just cannot put CMOs in that they're all as bad bucket. They
Correct.
can be fabulous to really actually be customized to everybody's unique portfolio and how they're
Yeah.
structured. So
Yep.
it just takes a lot of homework and expertise and understanding them and stressing the scenarios with them to make sure they work the way that you want them to, which is great.
Absolutely. The
Yeah.
one thing I didn't comment on here was yield. Um, this yield difference between an MBS and a CMO changes over time. There have been periods of time where mortgage-backed pass-throughs yield more than CMOs, and there are periods of time, like right now, where CMOs tend to yield a little bit more than MBS. So when we're talking about that yield piece, not only, we don't always want to go for the highest yielding option out there because it tends to be the riskiest. I say tends to be. Um, that value piece is, do you understand what you're buying and are you comfortable with it, even if it's yielding 10 basis points less than the next option that's out there?
Yeah. Nicely said. Okay, and now the next slide, I gotta just, before I hit, is it make everybody just bite their fingernails, wonder what it is,
I
wonder what it
know.
is a really good example of value in comparison in the municipal market of two, for two different types of bonds here. Kind of neat to kind of talk about these because as I look at these, we're not even showing the credits, but I believe these are very similar credits in them.
They are. Yes,
Okay.
I picked two bonds for this example that have the same credit ratings. I should have put that on there so that everybody can see it. I do want to note that these are not necessarily recommendations from McQueen Financial. This is simply for comparison purposes. Both bonds being in California. The top one there, Scent Basin Municipal Water, is a revenue bond due August 1 of 2031. That bottom bond, Los Angeles, California, is a general obligation bond, September 1, 2031. So there's a small difference between piece size there, but not anything significant. They're both in the same state. They both have a very similar maturity. They are both rated the same. If I remember correctly, they're double A. Um, but one is a revenue and one is a general obligation. And we have 23 basis points in difference on the offering level, with that revenue bond being offered at 44 basis points to the 5 year and the GO bond being offered at 21 basis points to the 5 year. There is always a difference in yield between a revenue option and a GO option, with the revenue should be yielding more. Again, market dependent. But just to show and highlight the difference between a revenue bond and a GO bond, because you are taking on more risk with a revenue bond versus a GO bond. And even from a risk weighting perspective, for those of us who have to calculate risk-based net worth or risk-based capital, revenue bonds are risk weighted 50% and GO bonds are risk weighted 20%. So there's a difference there as well. And we are being compensated by purchasing that revenue bond by picking up those extra basis points in yield.
Yeah, great example. Revenue bonds are good
They
bonds
are.
depending on the revenue source and
I
project.
mean, as long as we're not looking at grocery lot parking, revenue sources, then we're okay.
Exactly. I mean, I like that example. It's an extreme example, but it's
It
a very,
is.
very true example that
Absolutely.
there are some out there that could spread 150 basis points there,
Yes.
right?
Yep.
But it'd be really probably fall into a classified asset or a non-investment grade category
Yes.
very quickly.
Yep.
Um, And we have always been a big proponent of general obligations, and we still are.
Yeah.
but we want to make sure to say, hey, we do look at and we actively buy revenue bonds for that for value when those revenue sources are solid, consistent, historically showing
Yes.
good, solid financials. And we do
Yep,
recommend it for the rest of the world as well.
we do. Absolutely. The other thing that comes into play, and this is on the next slide there, is the piece size of a offering piece. This one here, I know it's a farther dated, again, not a live recommendation. There were two different blocks of this bond available in the market last week. The first one was 4.5 million, and it was being offered at 63 basis points to the 10-year. The second piece was 15,000, which was being offered at 75 basis points to the 10-year. So a 12 basis point difference. Why is there such a difference when it's the same bond? It holds the same credit. There's no difference other than the block size. That $15,000 piece is significantly harder to move in the institutional market than $4.5 million. If you think about the piece sizes that we buy for your portfolio, I mean, at a minimum, we're trying to buy between 250 and 500,000. For some of our larger clients, we are buying $3, $4, or $5 million blocks. To home a $15,000 piece just becomes trying for a lot of brokerage firms. So to entice people to pick that piece up, they're going to offer it at a higher spread in order to get somebody to buy it. Credit there is exactly the same. It just all has to do with block size.
This also works, and this is a question that came across,
Yeah.
but the question is proposed as, does this also work the same way when needing to liquidate a bond?
hmm It does. The only difference or caveat there would be on some of the BQ paper that we purchase and look at, the piece size may only be 100,000, but that's the whole maturity. So if we're purchasing the whole maturity and that's all it isn't necessarily frowned upon, but it definitely does get a little harder to move when we're trying to move $100,000 blocks of things versus $500,000 or $1 million blocks.
Okay. One other question flew in here, and I'm going
Yeah,
to ask him now instead of at the end. And
totally fine.
okay. Um, does the value change when it's a bond let's say it's a credit. They say for the same credit, is the value change at a new issue versus on the secondary market?
Meaning, did the credit, can you ask it a different way? I can't see
Um,
the question here.
I think the intent of the question is would spreads change if a bond comes to market and then the day two it's trading in the secondary, but interest rates didn't change? Is there a different yield that one could get on new issue versus secondary?
Ah, so there may be a slight difference. A lot of times that slight difference is going to come from, has the bond settled? If it hasn't reached its first settlement date yet, then no, it cannot change. If it has settled, even if it's an hour, let's say the bonds were supposed to settle at 3 and it's 4:30, that price could change. And part of that price change is going to be, who are you buying it from? Does the broker own that bond? Because the broker, in order to sell that bond to you, needs to make something because they also have to put their dinner on the table. That's how they make their money is on commissions. So what does that price change look like is going to be dependent upon the commission that that broker may charge on that bond.
Right. There's some supply and demand that comes out as well.
Yeah.
So it almost reminds me of like a hot IPO for a stock market or
Yes.
some go up, some go down,
Yeah,
right?
exactly.
But that's a good question. Thank you for answering that.
Yeah.
Okay, and now we're on to and I'm going to say it out, is commercial mortgage-backed securities,
Yeah.
CMBS.
CMBS. So we have a lot of clients who are interested in CMBS. Again, to kind of even that balance sheet out from a loan perspective versus the assets in the investment portfolio perspective. Some clients, they don't have a lot of commercial paper in their lending portfolio. So being able to add a little bit of that risk to pick up some extra yield when there's excess cash in the investment portfolio is this is how you can do it. So there's an example of a single bond here on this page. It's a standard Freddie K deal. This happens to be K544, which came a few weeks ago. Um, Freddie K's are CMO structures, so there are different tranches within the bond itself. I picked these two tranches out because they are a similar weighted average life. But there are some optionalities and some differences there. So the A2 tranche is a fixed rate tranche. Final maturity July of 2030 is a weighted average life of 4.9 years. We can see on there that the yield is 4.26%. And the AS tranche is the floating rate tranche. Maturity is 1 month shorter. Weighted average life is 0.1 years shorter. And the yield is a 489. So we're picking up a significant yield difference from 426 to 489 by moving from a fixed rate tranche to a floating rate tranche. The underlying collateral in this bond is fixed rate more often than not. However, they build a tranche that floats in order to provide a different option, different set of value to the investment world. So this tranche here, again, you're being compensated for the fact that it floats. We all know that we are potentially in a downwards rate scenario, so the yield on this will potentially shift downwards as SOFR shifts down because these bonds are priced on a spread to SOFR.
Gotcha. Neat example there.
Yeah. And our next example here is SBAs. We don't play too much in this SBA market. And I know that the screen is very busy, but I didn't want to have to filter back and forth or go back and forth between screen A and screen B. So I put both screens are on the same page here. So one bond has yellow boxes and the other bond has red boxes. But the big difference between the two bonds, actually, there's a lot of big differences. The yellow bond has a price of par, is par rate on the dot. The price on the red bond is 108 and 24, so a significantly higher price. And then if we look at the coupons of those bonds, we can see that the red bond has a coupon of 7.855 and the yellow bond has a coupon of 4.9. So the difference in price, or the difference in coupon, excuse me, being reflected in that difference in price. You'll notice that they have very similar maturities. I did this intentionally, again, to show the difference in the two bonds that have the same somewhat close maturity. The bond with the red boxes is being offered at prime plus 35. The yellow bond is being offered at prime minus 260. So they both have the same floating rate feature. They both have the same floating rate benchmark. One is a plus and one is a minus. That is impacting the price, which is being driven by the coupon. And then there's a big yield difference there too. It's 100 basis points. That bond there in red has a yield at zero CPR of a 4.96%, and the bond in yellow is 3.96%. So from a value perspective and a risk perspective, because the SBAs pay down a little bit differently than a traditional MBS or CMO from a CPR perspective and a premium amortization perspective, you're getting compensated 100 basis points for approximately the same weighted average life. I know it's 0.3 years difference, as close as I could find. But by paying that additional premium, that 8 and 24, 30 seconds, you're earning 100 extra basis points. You're buying a bond that has a much higher coupon than the other bond. So there's a difference in risk between the two bonds. And I simply wanted to show that by, again, putting both screens on the same page to show the differences between the two, because all of those different pieces are intertwined.
Yeah. It's interesting as we compare just one shift in yield or speed from 0 to 6 CPR, that 100 basis point spread compresses down to 64 basis
60-ish.
points.
Yeah,
Yeah, which is kind of what you just mentioned, Alicia, was that premium price that you're paying is that or some of that risk there, and just what does it work and how does it work with the rest of your balance sheet when the rates
yeah,
go down? So this is fabulous examples of what's out there
yeah.
and the same issuer there.
Yep. And then from
Excellent.
here, we kind of flip the table a little bit to talk about the yield curve. Because
Interesting.
one thing we talk a lot about is rolling down the curve. And what does it really mean? So we've got a little guy here riding the wave. Because I feel like we've all been riding this wave of volatility since March of 2020. Some days are a little busier than others. But what does it mean? What does it mean when we say we're going to let this bond roll down the curve or the portfolio is rolling down the curve? Going to flip to the next slide for me. Awesome. Um, so rolling down the curve, the yield curve gives us the value of a bond in the secondary market as our rates move. Um, That's how we price our things off of. And generally, as a bond approaches maturity, the market value gets closer to face value. So if we buy a bond at a premium, we amortize that premium down. It gets closer to par as it approaches maturity. If we buy it at a discount, it accretes up. It gets closer to par as it gets closer to maturity. So whether we are riding that wave from left to right and upwards or from right to left downwards, we are essentially riding that yield curve wave as we approach maturity on any given bond.
Yeah. Any kind of subtle changes in that curve or the term to maturity changes in yield help that time value of money change that price
Yep,
as as we get closer and closer, those fluctuations aren't going to move quite as much, but it's really good to really pay attention to that for portfolio management.
yep,
Something that's rolled down the curve, you can sell out and not necessarily take huge gains or losses, but roll into something that's even higher as well, as you
correct.
roll down the curve or surf down the curve, which that was a great picture, by the way. I really liked it. So,
Um, the next page actually gives us that exact example, Craig. So we have a treasury bond there. This is a treasury note, 0.625% due August 15 of 2030. I know I'm just reading the numbers. But we're going to purchase this bond because the coupon is so low at a very low discount, 85.25 and a half. So a purchase price of 85.796. That becomes important in a moment. The yield is 3.766. We're going to settle it on this date. And that's important to note because if you look in that red box there, what I did is pulled what the value of this bond would be, assuming no yield curve changes, shape stays the same as where it is today, August 16th of 2027. So 2 years and a couple days down the line. The horizon price gives us what the price would that bond would be if we were to want to sell it, and also what the yield is. You'll notice that the yield stays the same. It is constant. This is a fixed rate bond. It isn't going to change, but you'll notice that that price has increased because we have essentially rolled up the curve because we bought the bond at a discount. So the horizon price is 91.17 and some more change there. So we're able to see that price increase or that inc I want to call it a valuation, but that's not what it is. Um, that pickup for us is that bond has rolled up the curve closer to maturity.
yep. So as you're doing, it almost looks like, as I see this and look at the accounting method that you demonstrated is super cool, meaning a level yield is
Yep.
how that price goes out 2 years. If now interest rates had come down over the past 2 years when this bond was bought, or between now and 2027, because in 27 it's only what, a 3-year bond left, something like that.
Yeah.
So now you've got that natural price at 91, that's your rolled up price. And then
Yep.
if rates are in a 3.25 or something, that's just would be very reasonable to assume. All
Yep.
of a sudden, you've got a nice little gain on there as well to manipulate if you need to do some portfolio restructuring or want to just extend out the curve or shorten up however you can. This is a great example of how that works.
Yeah.
Excellent. Okay. Key takeaways, or no, market timing is
Market
us. I was
timing.
going one too far.
Skipping ahead a little bit
I know. So market timing, I wanted to talk a little bit about this because Alicia, do we not get this question all the time?
every day. Should I wait? Should I wait?
Yeah, or hey, I like the market, let's buy,
Yeah.
right? And it's not music to our ears. It's the conversation. What we like to have is what is our strategy, and make sure that we stick with that strategy with respect to portfolio management. Because we've all heard the saying that the person that tries to time the market lags the market
Yep.
because
Absolutely.
none of us are smart enough to actually beat the market from a timing
No.
standpoint. And so is the best time is now to understand what your strategy is and keep it steady with respect to implementing that. And when you have liquidity, and if it happens to be what I would like to say is an unusual or larger amount of liquidity that we may not have expected, okay, then maybe now is not the time to deploy all of that liquidity and maybe
Right.
spread that out, kind of the dollar cost averaging, because rates may go up or down. And as you said, we're at volatile times. And so sticking to that strategy and reinvestment into the marketplace, or as your balance sheet grows with liquidity and your need to grow your portfolio as well, do it in a very deliberate, strategic pace to do it instead of trying to time that market.
Yeah. What do
Uh,
we do though when there's market movement? So what if we think that rates are going to fall in 2 weeks? Or what if we think rates are going to fall in a month when the Fed may or may not make a rate change? What do we do to anticipate that?
so one is to check our interest rate risk position. And then number two, if you are fairly confident that rates are going down, then it would be good to be locking in some duration into that portfolio. You know,
Absolutely.
the opposite of that, if rates are expected to be rising, then you would keep it on the shorter time frame, because then you can reinvest into the higher rate environments.
Yep.
You don't want to necessarily bet on interest rates, but more of just if you have that general sense of what is happening with interest rates, that's what you want to do is the trend is your friend, and locking in that duration with a falling rate environment makes all the sense in the world.
The trend is your friend. I love it.
Yeah, absolutely. Okay, let's move onward. Make sure I'm on the right page. Key
Yep.
takeaways.
So our key takeaways from today. Duration is not linear as we often think it is. We talked about that. We saw an example, the easy up-down scenarios, but duration is affected by various items, not only in the market, but as well as on an individual bond level. Monitoring our convexity within the portfolio is important. It's something that we hear a lot. Don't buy negatively convex bonds, or we want to stay away from this because it's a negatively convex asset class, or what does the convexity on this bond look like? We need to look at it on a bond by bond basis, but also overall. And the best way to see that is to look at some of those market value changes within the portfolio. Continue to limit optionality. I think the one thing everybody experienced during COVID was if you had callable paper in your portfolio, it got called. Nothing really existed when we hit the floor. Everything had been called away. So that in part caused a significant amount of cash to have to be put back to work at a lower rate. All of those bonds negatively convex. So limiting that optionality in regards to call features. There are some asset classes, this is my caveat, which we simply cannot get away from them. Banknotes, corporates, some municipal bonds, especially those that in the revenue space, they're going to be there, but we have to be able to manage that optionality and manage that risk within the portfolio. And then the value in the marketplace will change from time to time, and we know this. So knowing and understanding that a diversified portfolio will in fact have the best returns. We can't put all of our eggs in one basket and say, well, today munis are good, so we're only going to buy munis and we're going to wait for that asset value to shift. We can't do that because when that asset value does shift, the whole portfolio is going to devalue or shift in value at the same time. We want to make sure that we're diversifying the holdings within the portfolio amongst multiple different asset classes because the value shift in individual asset classes happens at different times. Meaning, just because the value is there in CDs today and gone tomorrow doesn't mean that the value in corporates is going to be gone tomorrow. They will shift at different times based upon investor demand, current marketplace, and what the rate environment looks like.
Well said. Great takeaways on that. Um, this brings us to the end of our webinar this today. I want to make sure I say thank you to Alicia. Your conversation truly demonstrates your expertise in this field in balance sheet management, portfolio
Thank you.
management. Thank you for all of everything that you've provided today.
Yeah. Thank you very much for having me.
Yeah, you're welcome. Thank you for all of our attendees. I also want to just give a little shout out to next month. We are having a webinar for the ALM playbook, using your ALM model to optimize your balance sheet, manage your risk, and grow your institution, grow your earnings. That'll be on September 16th from 2 to 3 o'clock. And you can register for that. And it's a great this webinar, these webinars, and including the one next month, are great for your ALCO committee, great for your board members. It can be considered
Yep.
a part of your training and continuing education forum. It's just a really great way to empower people in your organization to learn and be connected with your balance sheet and how it's being run. So that's all I have today. Alicia, any closing words?
No, I don't. I hope everybody found some value in the webinar today. Enjoy your afternoon.
Absolutely. Thank you, everybody. Have a really nice afternoon.